First, the frozen Fed. They are officially trapped at 3.5% to 3.75%. They can't raise rates without fracturing the economy like a glass hammer hitting concrete. But they can't cut them without inflation going nuclear. This guarantees that real yields stay buried in negative territory. Then there's the oil factor, with oil sustained above $100 a barrel due to Iran war escalations and LNG shutdowns. Inflation expectations are rising much faster than interest rates. You are literally losing purchasing power every second you hold a dollar. But the real alpha is at the sovereign level. Central banks are buying gold at a staggering 190 tons per quarter, a pace with zero historical precedent. These are nations like China and India making decades-long geopolitical repositioning. Do you really think a sovereign nation stops its multi-billion-dollar strategy because an algorithm pulled its bids for 29 minutes? Of course not. They used the dip as a discount window. The March 19th crash didn't reveal a flaw in the gold thesis. It revealed a flaw in how most people hold gold. If you were leveraged to the hilt in paper futures, you got wiped out. That's just leverage doing what it always does eventually. But if you hold physical metal, March 19th changed absolutely nothing. In fact, while paper gold was being dumped, physical premiums actually expanded. Real buyers stepped in because they understood the game. That gap is the ultimate signal of who is selling the tourists and who is buying the OGs. We saw this in March 2020. Gold crashed 12%, then rose 40% over the next 6 months to new all-time highs. Phase 2 is where fear lives. Phase 3 is where wealth is built. JP Morgan's target of $5,055 was set before the Iran war escalated and before the Fed confirmed they were paralyzed. The case is stronger today than when that target was published. So, ignore the headlines designed to make you panic. The fire alarm was just a mechanical glitch in the plumbing. The question isn't whether gold will recover. The question is which side of Phase 3 you'll be standing on when it begins. Gold, silver, the Fed, or the yen carry trade? What's the next topic you want me to strip down to the bone? Drop it in the comments, because in this market, understanding the mechanism isn't optional. It's the only way to survive the stampede. Enter the catalyst. March 19th, the PPI print hits the wire, 0.7% hotter than expected. In a normal world, that's a data point. In a levered world, that's a detonator. Markets immediately priced in higher for longer rates. The dollar smashed through the 100 threshold, and currency math created immediate mechanical downward pressure on gold. That math unleashed the margin call cascade. Here's the dirty secret of Wall Street. When your other bets start hemorrhaging cash, you don't sell your losers. Nobody wants to buy your garbage. You sell your winners. You sell the thing that's gone up the most because it's the fastest way to raise cash. When you're getting margin called everywhere simultaneously, traders weren't dumping metals because they stopped believing in them. They were dumping them for survival. Then came the algorithmic amplification. High-frequency trading systems detected the cascading sell orders and pulled their bids simultaneously. This is the moment the theater exit doors actually got narrower, while the stampede got faster. In that 29-minute vacuum, sell orders pushed gold straight toward support levels, not because the bull run was over, but because the plumbing was broken. If you spent any time on financial Twitter or watching CNBC, you heard the same name over and over: 1980. Bears love this year because they think silver's 35%. Drop is a repeat of the Silver Thursday collapse, but they're reading the map upside down. 2026 is the mathematical opposite of 1980. In 1980, the Hunt brothers used massive leverage to corner the silver market. Their demand existed entirely on paper, propped up by borrowed money. When the exchange restricted trading to liquidation only, silver crashed 78% because there was nothing underneath it. No factories needed that silver. But in 2026, the demand isn't coming from three brothers with a checkbook. It's coming from the very foundation of the modern world: solar power, electric vehicles, and the AI revolution. Every server rack in an AI data center needs silver. This market has run a supply deficit for 5 consecutive years. That deficit didn't suddenly disappear because some algorithms had a 29-minute seizure. Here is the single sentence that separates this era from every prior crash. You cannot margin call a solar panel factory. A solar installation company doesn't stop building because silver had a bad Tuesday. The tourist money got flushed out in Phase 2, clearing the way for sovereign wealth funds and industrial consumers to buy the dip before Phase 3 begins. While the paper market was having a panic attack, the real movers, the people who run the world, weren't even looking at the screens. The structural case for gold is built on 4 pillars that actually got stronger during the crash. Look at your screen. That's not a software glitch. That is a full-blown massacre. March 19, 2026, mark the date. Because we just witnessed the largest single-day silver crash ever recorded, a 35% nosedive in one single day. While the headlines were busy screaming about the end of the world, gold was handing in its worst week since 2011, cratering roughly 10%. In total, $7 trillion in market value was erased from the global board. If you own precious metals, or if you've been following the thesis on this channel about how the Fed, oil, and runaway inflation are the 3 horsemen pointing toward higher gold prices, you just watched years of gains evaporate in what felt like a heartbeat, and I know exactly what's going through your head. The structural case for gold was bulletproof. It was supposed to go higher. So what the hell just happened? Here is the uncomfortable truth. This crash wasn't supposed to not happen. It was supposed to happen. In fact, it has happened in every single gold bull market in modern history, without exception. To understand why your screen turned bright red, you have to look past the doom and gloom headlines designed to make you panic and look at a very specific 29-minute window on the morning of March 19th, between 9:01 a.m. and 9:30 a.m. Something impossible happened. 98% of the buyers in the gold order book simply vanished. Imagine you're in a crowded theater and the fire alarm goes off. Everyone stampedes for the exits at the exact same second. The stampede doesn't mean the movie was bad, and it doesn't mean the theater was actually on fire. It just means the exits were too narrow for the number of people trying to shove through them at once. On March 19th, the global financial plumbing hit a localized vacuum. This wasn't a fundamental repricing of gold's value. It was a mechanical seizure of the paper market. When you understand what happened inside those 29 minutes and, more importantly, why it happened, everything about this crash changes. Every gold bull market follows a 3-phase pattern: the rally, the crash, and the reload. We just entered Phase 2, and for the investors who recognize the mechanism behind this $7 trillion evaporation, they aren't panicking, they're positioning. Before the first sell order hit, the precious metals market was essentially a powder keg waiting for a match. Prior to the crash, silver had surged an eye-watering 278% in just 12 months, and gold had jumped 96% to hit $5,400. These weren't just strong moves, they were crowded, heavily leveraged positions where everyone was leaning the same way. The CME Group saw the leverage building and tried to defuse the bomb by hiking margin requirements on silver futures 3 times. But the balloon popped anyway.